Imagine working for 30 years, paying off your mortgage, and finally holding the deed to your piece of the American dream in sunny Florida. Then, a single letter arrives in your mailbox. It's not a bill. It's a cancellation notice from your insurance company. No warnings, no negotiations, just a cold statement saying your neighborhood is no longer profitable to protect. This is the terrifying reality facing thousands of homeowners across the Sunshine State right now. When a property becomes completely uninsurable, a hidden financial trap snaps shut. Your home doesn't just lose value, it becomes legally frozen, turning from your greatest financial asset into a permanent liability overnight. And this is where things get ugly. Most people believe that losing home insurance is just a minor headache, something that can be fixed with a few phone calls to another broker. But in 2026, when a major private carrier drops your Florida policy, you hit a concrete wall. The private market has effectively blacklisted entire zip codes along the coast, from Cape Coral down to Naples. The mainstream real estate brochures are still screaming about price resilience and endless sunshine to attract wealthy out-of-state buyers. But on the ground, the reality is breaking independent middle-class families. Regular homeowners are opening their mail to find that their standard single-family insurance options have simply vanished. Of course, not every single county across the state is experiencing this exact level of pressure, and deeper inland sectors remain relatively stable for now. But for the vital suburban core within driving distance of the water, a dropped policy is the first step toward a total asset wipeout. When regular people realize that private insurance companies are no longer writing policies in their town, they often think, "I'll just drop coverage and take the risk." But if your home has a mortgage, the global financial system will never let you walk away from the table. Over 60% of residential structures in Florida are financed through a standard bank loan, and maintaining hazard insurance is a non-negotiable legal term of that contract. The moment your private policy expires and your bank detects a lapse in coverage, their automated compliance systems deploy a brutal penalty called force-placed insurance. The bank buys a temporary policy from their own preferred commercial vendors. It costs up to 4 times more than a standard premium, covers absolutely none of your personal belongings, and the cost is added directly to your monthly mortgage bill. If your household budget cannot absorb a sudden $2,000 jump in your housing overhead, the bank will move to foreclose on your property. The public narrative always promoted homeownership as the ultimate path to financial freedom, but right now it is a legal trap that strips away your independence overnight. What option would your family have if your bank suddenly doubled your monthly housing overhead without your consent? Naturally, wealthy cash buyers who own their luxury estates outright can completely bypass this banking leverage and go bare if they choose to take the risk. But for the working class living paycheck to paycheck, this carrying pressure triggers an immediate transactional freeze. This is the exact point where your paid-off property becomes a completely unsellable asset. When you try to list your home on Zillow or Redfin to escape the rising bills, the market reaction across these uninsurable zones is dead cold. Traditional buyers need a mortgage to purchase a home, and traditional banks require active property insurance before they release a single dollar of capital. If your neighborhood has been blacklisted by the reinsurance algorithms, the bank blocks the loan application, and the transaction freezes completely. The real estate headlines still print rising median home prices, but the reality on the ground is that everyday transactions are completely paralyzed because the property cannot be financed. Your life savings are effectively trapped in a structure you cannot afford to keep and are legally prevented from selling to an ordinary consumer. If a home was blocked from traditional financing, would you take the risk of purchasing it using your own hard cash in today's market? Granted, international investment pools are happy to look past these financing hurdles, knowing they can hold the raw land for the future. But for a regular family whose entire net worth is locked up in home equity, this transactional freeze leads straight into a silent bankruptcy. This process creates a hidden type of financial ruin that is taking over Florida in 2026. It doesn't happen in a courtroom, and it doesn't show up on a public credit check. It's called silent bankruptcy. Homeowners are forcing themselves to live on a strict survival budget, draining their retirement accounts and cutting back on essential medical care just to pay escalating carrying costs. They aren't technically losing their homes yet, but their liquid wealth is being systematically hollowed out by the system. The policymakers keep releasing reports claiming that household net worth across the nation is hitting historic highs. But the ground-level reality is an absolute cash drain that is leaving middle-class seniors completely broke inside their own expensive homes. Is it worth sacrificing your quality of life and your retirement security just to keep the title to a frozen real estate asset? To be fair, families with multiple streams of active business income are managing to absorb these cost shocks without altering their daily lifestyle. But for retirees living on a fixed pension, this financial strain is driving them directly into a massive corporate land grab. When an independent middle-class family is finally broken by these hidden carrying costs and forced to walk away, who do you think is waiting to buy the property? It isn't another local family trying to buy their first home. It is private equity sharks and multi-billion-dollar corporate landlords. Data from the first half of 2026 reveals that institutional cash buyers are snatching up these distressed, underinsured residential properties at an unprecedented rate. They don't care about the high cost of retail insurance because they self-insure their vast portfolios with billions in corporate cash, bypassing the banking system entirely. The mainstream headlines spin this as institutional investors stabilizing a volatile housing market. But the reality on the ground is far more sinister. They are systematically destroying middle-class homeownership to turn America into a permanent renter nation. Will your children ever have the chance to buy their own home, or will they be forced to pay rent forever to a Wall Street algorithm? Obviously, state-backed housing finance authorities are trying to launch subsidy programs to help local buyers stay competitive. However, the raw scale of institutional capital moving into the market is completely overwhelming these local defenses, and it's hitting the condo sector the hardest. Many retirees thought they could escape this entire crisis by downsizing into a beautiful oceanfront condo in Tampa or Fort Lauderdale, believing the building association would absorb the economic shocks. Instead, they walked right into a trap that is far more aggressive. Under strict structural safety mandates, building associations across coastal Florida are hitting a legal wall. Private insurance providers are refusing to sign master policies for high-density buildings unless the condo boards immediately fund millions in cash reserves for repairs. To avoid corporate fines, these associations are dropping unexpected bills called special assessments straight down to individual unit owners. Seniors living on a limited fixed Social Security pension are opening their mail to find surprise invoices demanding $40,000 due in full within 90 days. The developer brochures showcase a maintenance-free lifestyle filled with luxury amenities. But the reality is an absolute cash drain that is forcing vulnerable residents to liquidate their retirement cushions just to keep their keys. What would you do if your building association gave you a 90-day ultimatum to hand over $40,000 or face immediate forfeiture of your property? Of course, modernized luxury complexes built within the last 5 years feature high-efficiency engineering that keeps baseline operational costs manageable for residents. But for the traditional brick-and-frame buildings that house the true middle class, this fee explosion is a financial death sentence. If you are watching this from Texas, California, or the Midwest, and you think this coastal insurance meltdown is just a localized Florida issue, you are making a dangerous mistake. This is the exact blueprint for an unaffordable America. The identical corporate strategies and automated risk algorithms are being deployed right now inside the wildfire zones of California, the hail corridors of Texas, and the floodplains of Louisiana. The global banking and insurance networks are quietly rewriting the terms of property ownership across the United States, converting residential real estate into a high-yielding corporate commodity. The politicians keep releasing statements claiming the national housing market remains fundamentally stable. But the data on the ground proves that the core foundation of middle-class wealth is fracturing under the surface. Take a close look at your own property insurance renewals and municipal tax statements this month. Are you starting to see the early warning signs of the squeeze appearing in your hometown? Share your local numbers and your experiences in the comments below so we can track how fast this structural shift is moving across the nation. The United States has an incredibly resilient financial system, and grassroots legal challenges may eventually force regulators to step in and limit how corporate capital manages residential risk. But before those macro solutions arrive at your doorstep, individual homeowners must recognize the reality of the trap before the system locks them in permanently. Subscribe to stay informed on these hidden economic shifts, protect your wealth, and we will see you in the next report.